I mean, the market's pricing in 2 cuts between now and year end. I would say, to me, 2 cuts make sense if the Fed realizes real interest rates are too high because tariff inflation is transitory. And so they should look at the break evens and realize 4.5% Fed funds versus 2.5 is 200 basis points extremely tight. If you don't even think you're going to hurt the job market, it's clearly hurting the job market.
Do you think more rate cuts all of a sudden rejuvenates the job market, or not necessarily?
I think that a dovish cycle is going to get the ISM back up. So I think it actually is expansionary.
Okay.
And of course, on the housing, it's very expansionary. I think that there is a very high probability, I'm going to say maybe even 50%, that Ethereum's network value will flip Bitcoins.
Wow.
Like when?
The flippening.
Maybe in a couple years.
People have been saying this for a long time.
Yeah.
How much bigger is Bitcoin now? Is it
It's
six times?
2.2 trillion right now.
And ETH is what, 400 billion?
Yeah.
All right.
But you're not an ETH maxi. You think?
I'm not. I'm
you
still a
think there will be
Bitcoin bull.
both?
I think Bitcoin's
Okay.
going to 1 million, but I'm saying like Ethereum's relative size, the ratio will actually be 1-to-1.
Tom Lee begins by revisiting one of the most misunderstood market phenomena, the V-shaped recovery. According to Lee, markets are inherently symmetric. If the market sells off quickly, history shows it typically rebounds just as fast, unless a recession is in play. He cites data that shows if it takes 8 weeks to lose 20% in a waterfall drop, markets usually recover that loss in about 1.4 times that length, so roughly 11 weeks. Despite this pattern, investors remain skeptical.
Please take a little time to like this video, subscribe to the channel, and turn on post notifications for more videos like this. You can also check out our other videos on cryptocurrencies and the overall digital asset space and drop your comments and observations in the comments section below. Everything you do helps with the YouTube algorithm and immensely contributes to the channel's growth. Thanks and enjoy the video.
I mean, that was a complete drawing up of buying power and then a complete loss of confidence from the CEO level to everybody in the world because no one had an answer. So you could see why you'd have this huge air pocket. But I do know 2 things, that markets are symmetric. So the faster your decline, the faster the bounce. That's
always?
Yeah.
Chartkit has a great one on
Yeah,
that.
yeah. So we showed that basically, unless there's a recession, it's always a symmetric bounce. It's the ratio is like 1.4 to 1.7. So if it took 8 weeks to lose 20, you'll recover it back in 1.4 times that length.
Oh, okay.
So in other words, it's always like there's a
symmetry.
ratio.
Why?
Yeah.
So why do so many people think V-shaped recoveries are anomalous when, based on what you're saying, they're actually the norm?
I think people don't study history. I think they study their own sensibilities. They're saying like, oh, well, if you lose confidence, it's going to take me this much longer to recover. That's why everyone says there's a K-shaped or square root.
You hear like U-shaped recovery a lot too, right?
Correct. Like every letter but V.
Yeah.
And
it's always a V.
It's always a V.
Tom, so you did the work. You've got 12 waterfall declines since 1929. Do you think that this is what we're going to see going forward?
Yes. Actually, maybe
What's a waterfall decline? What's the definition of that?
Oh, well, it's a term we coined probably around the 2012 period, but it's when the market has a high velocity decline.
Okay.
So like if you say...
like a lightning fast sell-off.
Yeah, so the fastest declined to 10% or the fastest down 20.
So rather than like dribbling lower, when it just like the bottom falls out.
Yeah, it's like you sprung like the ship is just sank.
All right, so here's 12 of these. And just for the listeners who aren't looking, we have dates in here like 82, 87, 2002, 2009, 2020, 2025 is now on the list officially.
Yeah.
That was a big one. That was 20%, and it was like overnight.
Yeah.
Okay.
And usually no retest, at least in modern history.
That's right. I mean, it will look like a retest, but no. Usually, that's another thing. People say there's always a retest. It might be true at the stock level because there's sellers that want to get out, but at the index level, it's actually rare.
Yeah, I actually would say post-financial crisis, there are no retests.
Yeah.
Like that's it. If you don't nail that moment, it's okay. You could still buy later, but you're not getting 2 chances at the bottom.
Yeah, you're buying higher.
You're buying higher, and that might be okay for people.
The Fed's not going to save us, and we kept saying it's waterfall declines are V-shaped, but no one could really believe it. But now that we recovered, at least we're not getting yelled at. I mean, the market's pricing in 2 cuts between now and year end. I would say, to me, 2 cuts make sense if the Fed realizes real interest rates are too high, because tariff inflation is transitory. And so they should look at the break-evens and realize 4.5% Fed funds versus 2.5 is 200 basis points extremely tight. If you don't even think you're going to hurt the job market, it's clearly hurting the job market.
Do you think more rate cuts all of a sudden rejuvenates the job market, or not necessarily?
I think that a dovish cycle is going to get the ISM back up. So I think it actually is expansionary.
Okay.
And of course, on the housing, it's very expansionary. Ethereum, number one, is where the stablecoin boom is taking place. 60% of it. So like this whole Genius Act, Besant says stablecoins are going to go from 250 billion to 4 trillion. That's an exponential demand growth for Ethereum.
They're replacing money market funds.
Correct. And
Okay.
it's dollarization and all that. Ethereum pays a 3% native yield if you stake it. So the 6.6 billion held of Ethereum is over $200 million in net income right now. The day we turn on staking, not only is there no debt on Bitminer, it's going to pay you $200 million a year in dividends.
And what do you do with that? Buy more Ether?
Or we might just pay it out as cash dividends.
Where does that 3% native yield come from? Is that gas fees that
so
users
it's
are
called-
paying to use ETH?
Well, it's called proof of stake. So Ethereum doesn't have a proof of work model where you're competing for a block reward. It's saying if you hold ETH and you agree to stake it and validate transactions, you earn the staking fee, which is 3%.
Okay. So that's where that's coming
Yeah,
from.
and then there's a power law force at work that if we get to 5% of Ethereum, we become a really benevolent staking entity. That's why we want to get to 5%. 480 billion right now of fully diluted network value.
Okay.
But
Is the supply contracting or not yet?
it's actually growing about 1%.
Growing
which is
1%.
slower than Bitcoin's inflation rate.
Okay.
It's actually a third of Bitcoin's inflation rate.
Okay.
Now-
How big do you think that could be?
Well, I think that there is a very high probability, I'm going to say maybe even 50%, that Ethereum's network value will flip Bitcoin's.
Wow.
Like when?
The flippening.
Maybe in a couple years.
People have been saying this for a long time.
Yeah.
How much bigger is Bitcoin now? Is it
It's
six times?
2.2 trillion right now.
And ETH is what, 400 billion?
Yeah.
All right.
But you're not an ETH maxi. You think
I'm not. I'm
you
still a
think there will
Bitcoin
be
bull.
both.
I think Bitcoin's
Okay.
going to 1 million, but I'm saying like Ethereum's relative size, the ratio will actually be 1-to-1.
While Lee isn't an ETH maxi, he does believe Ethereum has a 50% chance of surpassing Bitcoin's market cap, an event known in crypto circles as the flippening. Today, Bitcoin sits at $2.2 trillion, while Ethereum trails at around $400 billion. But with the growth of decentralized finance, smart contracts, and real-world applications, that gap could narrow quickly. Despite that, Lee remains bullish on both.
When you are this far forlorn and dejected, and then you flip positive, you won't just go to 50 and then it's over. We're probably going to have 4 years of this staying above 50. I mean, if you look at the history, once it breaks above 50, it's multiple years. But this could be a record stretch above 50.
This is bizarre. Talk through the chart that we're looking at. Like this most recent episode of the ISM below 50 and the stock market just relentlessly grinding is not typical.
Yeah, I would say like maybe the people answering these surveys are just not terribly important to the economy anymore in the way that they once were.
ISM is still more correlated with S&P earnings than the services
Okay.
index. Because
So-
we're more of a manufacturing.
Who are the people commenting for this survey?
So it's members of the Institute of Supply Management. So it's basically the
It's
survey.
like factory foreman? Like
But it also could be the Intel, NVIDIA purchasing manager. Although
right.
they get one vote, right? They get one survey.
okay, so tech is in here.
Everything's in there.
Okay. So you're saying that this is like a coiled spring.
Yeah.
Okay.
It's-
But what makes this flip positive? Because we're not gonna get 2% inflation unless something's really going wrong. So what do these people need to flip positive?
I think we need policy stability, which could come next year, like from the White House, I mean.
Oh, this White House is known for stability. Okay, I'm with you on that.
Yeah.
What else?
Okay, or it doesn't get more unstable.
Okay.
You get a Fed that's dovish,
Okay.
which is cutting.
You're probably gonna get that, if not now, but at a minimum by May.
Yeah. But then you need this third thing to happen. You need the excess spread on interest products to fall. Like today, if you're borrowing for a mortgage, it's normally only been at 160 basis points above the 10-year, or like 1.6%. So the 10-year's at 4.2. The 30-year mortgage should be 5.8.
But it's not.
But it's like 7. So there's excess spread on mortgages. But as
Okay.
soon as those other two things happen, I bet you that spread drops.
What is the source of that spread being so high?
It's actually hard to explain. Someone says that it's either banks worried about prepayment velocity, so because they're going to charge, so they charge an excess spread, or it's uncertainty about the value of the collateral. Like, can home prices drop so you have to charge a high rate because they're only putting 20% down? This one has been particularly reviled, I think, because one, the speed of the recovery has been so fast. As you know, many people rage sold in April because they're like, look, the economist told me 60% chance of recession. That's the same as a sell rating on the stock market. And they went to cash. They couldn't redeploy it because there was no pullback.
It was too fast.
Too fast.
Is that what creates a hated rally?
Yeah.
That phenomenon, like people don't get back in fast enough?
Yeah, and I think it just shows you that people don't operate with independence. They operate with a bias. They think when something bounces, it's just dumb people buying, and that prevents them from jumping on with the buy. I mean, think about Palantir and Tesla. Netflix, they were all like retail stocks. Like someone was telling me the first time that they tried to buy Tesla institutionally, they had to bring in this like research firm from Oregon that wrote a report on Tesla. Okay, this is Jennison.
Yeah.
And like that was the first time that research firm ever got called to go to New York to actually meet a hedge fund.
Oh, wow. Okay.
So like, all the really big churns come because someone recognizes it, and it's not often like the crowd that recognizes it. I think that there's many reasons to argue market will expand because the Fed has been on hold all year. So they're neither dovish or hawkish, but if they resume cutting, it's a dovish cycle resuming. That's broadening. The ISM's been below 50 for 30 months now.
Why does that matter?
Well, it's a sign of business confidence. Like the CEOs of these companies, because now I'm chairman of a company, like there's no internal economist. You get your economic view from the Fed and from like Wall Street, right? And so if the economists are cautious, like companies are cautious. That's why the ISM's been suppressed. But that means you're not funding CapEx beyond demand. So expansionary spending hasn't taken place. That's a broadening. And then the third, of course, is that AI, agentic AI, we're kind of moving into the phase where we're seeing useful applications. That means companies are using AI to actually grow their business. That should be broadening opportunities, not just...
Lee also touched on market psychology. Many investors sold in April, following economists projecting a 60% chance of recession, the equivalent of a sell rating. But when markets rebounded sharply, they were caught off guard. This created what Lee calls a hated rally, a scenario where those who sold are left on the sidelines, resentful and skeptical of the move. He believes this is more common than people think and stems from the herd mentality of markets.